What if, and just hear me out on this, what if the most important hardware in the entire AI revolution isn't actually processing the data, but just simply moving the light?
Oh, I mean, the hyperscalers are already acting like it is.
Right. Wall Street is completely violently divided on this. You've
Yeah.
got this $6 billion challenger, Marvell Technology, and they are actively trying to unseat Broadcom. And, the whole debate really comes down to one fundamental question, like, are we entering this structural era where networking, memory pooling, and optical interconnects matter way more than raw compute?
Well, yeah, and if you look at Google, Meta, Microsoft, Amazon, they're all basically screaming that we are. I mean, they are hitting very real physical heat and bandwidth limits in these data centers.
Yeah, you can't just brute force it forever.
Exactly. You can pack, all the computing power you want into a single server rack, but if those chips can't exchange data at terahertz speeds without literally melting the copper wiring, then your, billion-dollar AI cluster is just a really expensive space heater.
A very expensive space heater. Well, welcome to the Time and Market Deep Dive, everyone. Before we completely tear into the mechanics of all this, just a quick reminder that this is purely for entertainment purposes, okay?
Mm-mm.
So please, seek professional advice for your own investments.
Yeah, definitely do your own homework.
Always. So our mission today for you listening is to unpack this absolute mountain of recent earnings data, 10-year discounted cash flow models, and some highly, highly polarized analyst notes on Marvell Technology. That's ticker MRVL.
Yeah, the analyst divide on this one is just wild.
It's insane. So we're going to tear down their Q1 fiscal year 2027 print. We'll measure their valuation against their intrinsic value.
Yeah.
And we're going to look really closely at the physics, yes, the physics of their recent photonics acquisitions.
Right, because the underlying tension in all of these sources we looked at, it's all about this massive transition from AI training to AI inference.
Right.
Because training a model, that's just brute force calculation. But inference, when you or I actually type a prompt and query that model, that is entirely about data throughput and latency.
And Marvell is basically betting their entire product roadmap on that, right? The connectivity is the absolute choke point of this new inference era.
100%. And I mean, that thesis really seems to be playing out if you look at their Q1 FY27 earnings print.
Oh yeah, let's get into those numbers. They added, essentially $250 million in sequential revenue in just 90 days. Record total revenue hit $2.418 billion, which is up 28% year over year.
Yeah, it's a huge top-line beat.
But what really stood out to me immediately was that virtually all of that new weight is being carried by just a single segment. Data center pulled in $1.83 billion. So that's now 76% of their entire revenue base.
It's basically becoming the whole company.
Exactly. The legacy communications business is like almost an afterthought now. It's just sitting at $585 million.
Well, and that data center segment is growing at an aggressive 11% sequentially, which is mostly fueled by their custom ASICs and optical networking gear. But that hypergrowth in custom silicon, it introduces this really structural financial reality that investors have got to digest.
Yeah, the margin compression, I noticed that in the data too.
Right.
Because they printed this record top line, but their adjusted non-GAAP gross margin actually slipped. It went down 20 basis points to 58.3%. I'm sitting here thinking, if custom ASIC programs, building these bespoke chips for a specific hyperscaler's unique workload, if that's supposedly the holy grail for locking in sticky long-term customers, why does it functionally depress their margins?
Yeah, it seems counterintuitive.
Right. Isn't that a huge flaw in the long-term business model?
Well, no, not necessarily. It's really a trade-off between your margin percentage and your absolute gross profit dollars.
Okay, unpack that a bit.
So off-the-shelf networking products, they carry a lot of proprietary IP and software leverage, right? So that lets Marvell command higher margins. But custom ASICs, they involve heavy, non-recurring engineering costs.
Because you're designing it from scratch for one buyer.
Exactly. You are co-designing hardware tailored to, say, Google or Amazon's specific architecture. And because the hyperscalers is committing to these massive multi-year volume orders, they demand bulk pricing.
Oh, so they're negotiating the price way down.
Right. So Marvell just accepts a lower gross margin percentage in exchange for this massive guaranteed flow of gross profit dollars and, a virtually unbreakable vendor lock-in.
Okay, but that guaranteed volume requires guaranteed manufacturing.
Oh.
Which brings up this pretty fascinating line item from the earnings call. The CEO committed to a $1 billion supply chain prepayment for the fiscal year.
Yeah, that made a lot of waves.
I mean, handing over $1 billion in cash to TSMC, Taiwan Semiconductor, That reads less like standard supply chain management and more like, I don't know, buying VIP access to a very exclusive club.
That's exactly what it is, because
Mm.
you are looking at the mechanical friction point of the entire AI industry right there. The bottleneck isn't even just printing the silicon wafers anymore, it is the advanced packaging.
The CoS stuff, right?
Yes, TSMC's CoWoS, chip on wafer on substrate. Because when you're stitching high bandwidth memory and logic dies together on a silicon interposer, it creates immense thermal and physical stress on the package.
And there's only so many machines that can do that.
Exactly. TSMC only has a limited number of machines capable of executing that without literally warping the chip. So Marvell's billion-dollar prepayment is explicitly to secure time on those specific packaging machines.
So they don't get shoved to the back of the line behind NVIDIA.
Right. When a hyperscaler orders a custom ASIC, Marvell needs to know they won't get stuck behind NVIDIA or AMD in the fabrication queue.
Okay, but let's run Marvell's current market reality through a bit of a stress test here.
Yeah.
Because the stock action recently has been, frankly, highly disjointed from that aggressive operational maneuvering.
Oh, for sure.
Like, the stock recently closed at $198.70, taking a 4.59% hit on the day, and it showed even further weakness after hours. And if we apply a standard 10-year discounted cash flow analysis to this, the math gets sobering really fast.
Yeah, it definitely requires some very aggressive assumptions to justify that current price.
Yeah, so let's walk through it. If we model a 10-year DCF for you guys listening, utilizing a pretty conservative free cash flow base mapped to their current trajectory, and we project a steady 9% annual growth expectation.
Which, by the way, is historically very strong for a mature semi-company.
Super strong. But even with that, the valuation disconnect is just glaring. When you discount those cash flows back at a 10% rate and apply a standard 2.5% terminal growth rate, the calculated intrinsic value lands somewhere around the $85 to $90 per share mark.
Yeah. Which means at nearly $200 a share, the stock is trading at more than a 100% premium to its baseline DCF intrinsic value.
100% premium. That's just wild.
It is. The market cap sits at roughly $173.7 billion right now. And based on the Longbridge analysis we reviewed, that puts Marvell trading at an eye-watering 37 times its fiscal year 2028 adjusted net income.
And FY28 is essentially calendar year 2027.
Right, so investors are paying a massive premium today for earnings that literally won't materialize for another 2 to 3 years.
Which completely explains the tug of war happening among analysts right now. I mean, the consensus target from 32 analysts is sitting at 152.97, which obviously implies downside from where it's trading today. But the polarization is just, it's wild.
It really is.
You've got Cantor Fitzgerald looking at a metric similar to our baseline DCF, and they're maintaining this super bearish $75 target. But then, meanwhile, HSBC is just completely ignoring the baseline. They're modeling a hypergrowth scenario, and they just upgraded Marvell to a $300 target.
Well, the divide centers entirely on how you classify the stock. You know, like if you treat Marvell as a traditional semiconductor company, then that $75 target makes perfect sense.
Right, the fundamentals just aren't there for $200.
Exactly. But the market is currently pricing Marvell as a pure-play AI infrastructure asset. And that classification carries incredibly high beta. The moment a hyperscaler even hints at dialing back capital expenditures, that 37 times forward multiple is going to violently compress. Basically, Marvell is priced for absolute perfection right now, meaning even a quote-unquote good quarter where they simply meet guidance is often punished.
Because the institutional money was modeling a miracle.
Exactly.
So the ultimate stress test for that premium valuation has to be their ability to continuously capture market share from Broadcom. Because Broadcom is the $50 billion Goliath in this arena. They currently hold roughly 70% of the custom AI accelerator market.
Yeah, they are the incumbents.
And they offer mid-60s gross margins, incredible cash flow stability backed by their VMware software acquisition. But then you have Marvell, sitting on just a $6 billion revenue base, and they just secured a portion of Google's next-generation TPU work.
Yeah, and that is a watershed moment for Marvell.
Because it essentially ends Broadcom's perceived monopoly on Google's flagship silicon.
Right. Hyperscalers despise vendor lock-in. They hate it. So Google multi-sourcing their custom silicon proves that Marvell's underlying IP portfolio is actually mature enough to meet the most demanding workloads on the planet. It totally forces Broadcom to defend its territory now, rather than just, collecting rent on legacy designs.
Wow. And I'm looking at another strategic move from the sources, too. NVIDIA recently took a multi-billion-dollar stake in Marvell to fund co-development on NVLink-compatible interconnects. To me,
Mm.
I mean, that reads like an aggressive hedge by NVIDIA,
Oh, absolutely.
because they know the hyperscalers are actively building custom ASICs to bypass expensive NVIDIA GPUs. So if NVIDIA is going to inevitably lose some of that pure compute market share, they at least want their proprietary NVLink standard to serve as the toll road connecting all those custom chips together.
That is a highly astute reading of the board. NVIDIA wants its rack-scale architecture to remain the undisputed standard. So by integrating Marvell's optical digital signal processors, or DSPs, directly into the NVLink ecosystem, NVIDIA ensures their networking protocols remain sticky, even if the underlying compute chips belong to someone else entirely.
Right. It gives the hyperscalers the flexibility to mix standard GPUs with custom ASICs.
Exactly. Utilizing Marvell's networking bridge to allow completely different architectures to talk to each other seamlessly.
It's brilliant. And this is a but both Broadcom and Marvell share a terrifying structural vulnerability here, right? Extreme customer concentration.
Yeah, it's the elephant in the room.
The entire bull case for both of these companies rests on the capital expenditure budgets of just 3 or 4 hyperscalers. If Meta decides to delay their MTIA chip cycle, or if Amazon pushes back their Trainium deployment because they need to focus on cooling infrastructure, the growth narrative for both Broadcom and Marvell seizes up instantly.
The concentration risk is absolute. You are underwriting the continued uninterrupted spending of the tech oligopoly. If any of those four players sneeze, Marvell's FY28 guidance of $16.5 billion catches a cold.
And to hit that $16.5 billion target, which, by the way, implies a staggering 45% annual growth rate, Marvell is relying heavily on an optical technology overhaul. In the earnings call, management noted their interconnect business is tracking for over 70% year-over-year growth, and the data center interconnect modules alone are pacing toward a $1 billion annualized run rate.
Yeah, and this is where we kind of have to leave the economics and enter the physics of data movement.
Get to it.
Because as inference workloads scale, right, specifically things like agentic AI, where a single user prompt might trigger the model to query itself thousands of times asynchronously, the latency between servers becomes the critical failure point. We are moving from scale-up architectures, which is connecting chips inside a single dense rack, to scale-out architectures.
Where you need, what, tens of thousands of servers?
Tens of thousands of servers across a massive physical data center, all acting as a single coherent processing engine.
Right. And traditional silicon photonics are just hitting a physical ceiling, trying to handle that scale-out traffic. Moving data electrically generates resistance, and resistance generates heat.
Lots of heat.
So when you try to push terabits of data through copper, or even standard optical transceivers, the electrical to optical conversion process just requires way too much power and physical space.
Which perfectly contextualizes Marvell's aggressive M&A strategy,
Yeah.
specifically their acquisition of Polariton and their plasmonics silicon photonics technology.
Plasmonics. Okay, break that down for us.
Well, plasmonics operate on a completely different mechanical principle than standard optics.
How does that actually function at a hardware level? I know they're like modulating light at the nanoscale, but how does it bypass the heat bottleneck of traditional photonics?
So instead of just shining a laser through a silicon waveguide, a plasmonic modulator traps light on the exact boundary between a metal and a dielectric material. And this interaction creates what are called surface plasmon polaritons. It essentially compresses the light wave to a size much smaller than its own wavelength.
Wow.
Yeah. And because you are modulating the signal at the nanoscale, the physical footprint of the transceiver shrinks dramatically. The power consumption drops, and you can achieve bandwidth exceeding 1 terahertz per channel.
That's incredible. So you're moving vastly more data without generating the thermal load that would normally, melt the server chassis.
Exactly.
Well,
But they aren't just attacking the networking bottleneck, they're going after the AI memory wall as well.
right. They acquired Structera, which brings CXL memory pooling into their stack.
Yep.
Because from an inference perspective, high bandwidth memory is just prohibitively expensive to scale infinitely, and standard DDR5 memory is too slow to feed a GPU cluster. So how exactly does Marvell's CXL fabric, trick the processing unit into thinking it has local high-speed memory?
Okay, so CXL stands for Compute Express Link. And the fundamental problem it solves is cache coherence. Historically, if a GPU needed data from a different server's memory bank, it had to send a request through the CPU wait for the operating system to allocate the data, and then send it back.
Which takes forever in compute time.
Right. That latency leaves the incredibly expensive GPU just idling.
It's like paying a brilliant engineer a massive salary, but, forcing them to walk across town to a public library every time they need to check a reference book.
That is a perfect analogy. So Marvell's CXL technology intercepts the PCIe lanes and creates a shared, coherent memory domain across multiple servers. The GPU sees a massive pool of slightly cheaper, slower memory, but accesses it as if it were sitting directly on the motherboard.
Oh, wow.
Yeah, the hardware manages the cache coherency in the background without even bothering the software layer. Marvell isn't just selling a networking chip here, they are selling a solution to a systemic data starvation problem.
Okay, so we've mapped out the earnings momentum, the physics of their photonics, and the extremely aggressive multiple the market has assigned to them. Based on the valuation metrics and the competitive landscape drawn from all of these sources, what is the ultimate buy, hold, or sell verdict for the listener right now?
Well, the verdict depends entirely on your appetite for drawdown risk and how you weigh the current share price against that calculated intrinsic value.
Fair enough.
If you're looking for a foundational tech asset with a real margin of safety, the consensus heavily favors Broadcom as a buy or a stronghold. You get the entrenched market leader in custom silicon, insulated by durable software revenues, and it's trading at a much more digestible multiple relative to its cash flow.
So Broadcom is basically the battleship. It turns slowly, but it is heavily armored against a market correction.
Exactly. Marvell, conversely, is a high beta interceptor. At 198.70, it is trading at a steep premium to its baseline DCF intrinsic value. If you demand traditional value metrics, Marvell is a sell. However, if you're willing to underwrite the aggressive growth curve, if you can tolerate the extreme sensitivity to hyperscaler capex, and you fundamentally believe that plasmonic photonics and CXL memory pooling will capture outsized infrastructure spending in the inference era, then Marvell is the momentum buy. You are intentionally overpaying today for the promise of their FY28 reality.
Thank you so much for joining us on this deep dive. And we want to leave you with a final provocation to consider a risk factor lurking just beyond the horizon of this current hardware cycle.
Yeah, it's a big one.
Marvell's entire near-term financial narrative is heavily reliant on selling pluggable optical modules and their current generation of digital signal processors. They frequently point to their 15 billion hours of field data as this impenetrable moat. But in an industry pushing against the literal boundaries of physics, paradigms shift ruthlessly.
They absolutely do.
So what happens if the leap to co-packaged optics, where the optical lasers and modulators are baked directly into the compute silicon itself, bypassing the need for separate pluggable modules entirely too? What if that happens much faster than Wall Street anticipates?
That changes everything.
Could the very discrete networking technology fueling Marvell's massive premium today be structurally engineered out of the server rack by the hyperscalers before that 16.5 billion fiscal year 2028 ever arrives?
It's a terrifying thought for bulls.
It really is. When you invest in the physical infrastructure of the AI revolution, you are betting on architecture that is invisible to you and changing by the microsecond. Are you buying the permanent foundation or just a highly lucrative temporary bridge? Think about it.